Okay, good evening, everybody. Thank you so much, Philip and XBTO, for hosting me and providing me with this great opportunity to speak to this wonderful crowd. And thank you, everybody, for coming at this time. I'm going to talk today about Bitcoin and some of the main ideas in my first book, The Bitcoin Standard, and also drawing in on some of the ideas of my other books, The Fiat Standard and Principles of Economics. But I'm going to focus really on trying to make the case for Bitcoin as I see it. And this is something that I've been working on for 6 years since I published The Bitcoin Standard, and I think I continuously get new ideas of trying to refine this and explaining what I see as the investor case for Bitcoin. So to begin with, we begin with the question of what is money. And if you've read The Bitcoin Standard, my book, you'll see the first 7 chapters of the book do not even mention the word Bitcoin. They effectively discuss the history of money, which I believe is enormously important for understanding why Bitcoin is so significant and why it's not just a fad. So money, the definition of money is that it is anything that you use as a medium of exchange. And this is quite a technical definition, because it means that you buy something not for the sake of consuming it itself. So it's not food, it's not a house, it's not clothes, things that you consume for the benefit that they give you. And that's called a consumer good. And it's also not a capital good, meaning that it's not a good that you acquire so that it produces things. So you don't buy a sewing machine because it helps you make t-shirts, for instance. That's a capital good. Money is neither of those things. You don't eat the money, you don't consume it, you don't get pleasure from having it, whether it's paper bills or gold or Bitcoin. You don't acquire those things for their own properties as a consumer good. You acquire them purely for the sake of exchanging them later on. So a medium of exchange is something that is purchased with the express purpose of later on being sold for something else or exchanged for something else. Something you merely acquire so that you can exchange it later on. So once you understand that as the definition of money, that money is the medium of exchange, you realize that anything can be medium of exchange. There are no limits on what you can use as a medium of exchange. So you can decide to buy a chair and then try and liquidate the chair in order to buy something else. But of course, just because you can do it doesn't mean it's a good idea. So some things are good as money, some things are bad. And how do we distinguish between the two? That is the main thesis of the first 7 chapters of the Bitcoin Standard, which is that I go through monetary history and present a hypothesis for what I believe is the distinction between good and bad money, and try and apply it to different kinds of monies across history and see whether it fits with the narrative, and I think it does fit. So the basic idea is this. You can use anything as money. And there are some physical properties that make some forms of things, some forms of matter better than others as money. That it's divisible, that it's easy to move around, that it doesn't corrode, doesn't rust. So we can immediately discount anything that's perishable like food, because that's obviously not going to be good. You want things that last, things that are easy to divide into smaller denominations and to combine small denominations into a bigger denomination. But beyond that, we still see there is one very important property, because these things become more and more trivial. You know, by 1600, metallurgy had advanced in most of the advanced world, at least, enough that we could make all kinds of nominally useful forms of money out of any kind of metal. You could make metal coins, iron coins, copper coins, gold coins, silver coins. But one thing distinguishes what is a good money from bad money, which is that the good money has a way of stopping its supply from increasing. That's really the key thing. Because you can choose to make anything as money, but if you choose to make it money, what you're doing is you're increasing demand for it. So if everybody today decides that they want to use copper as money, and people start liquidating all their monetary assets and acquiring copper instead, that's going to necessarily raise the price of copper, right? Because we already have a lot of demand for copper for industrial uses. Now we're adding on top of it monetary uses, so people that are buying copper just to store it and sell it on later. But if there's more demand, that means the price goes up, which seems like a nice thing, right? You want your money to appreciate. You buy copper and then the price of copper goes up. That means you have more money. That's a great thing. But what happens next? Well, the price is appreciated. Now the people who can produce copper, they are able to produce more copper. They have more money because they're selling more copper at a higher price. You're effectively subsidizing them and giving them the resources for them to make more copper and thus devalue the copper that you have. And that's what ends up happening. So there's always increased production as a response to the adoption of anything as money. If you choose anything as money, you're going to increase its price, which is going to lead to an increase in the production, which destroys the value of the money. So the net result is that eventually all of the money that was stored in these bad, all the wealth that was stored in these bad forms of money goes to the people who can produce that money. So if all the world's richest people decided tomorrow that they wanted to put all of their wealth in copper, that's just going to make a lot of copper miners extremely rich. The copper miners are going to rule the world, and copper is not going to become money, because somebody like Bill Gates or Jeff Bezos will have to buy hundreds of billions of dollars worth of copper and store them in an office, and it doesn't matter how much they buy, the copper miners can keep producing more. So the conclusion is that only things that are hard to make succeed as money in the long term. And as I go through in my book, which you have between your hands, you can see all of these examples of things that are being used as money. And you see that at any time and place where these things were used as money, they were used as money because they were hard to make. Limestones were used in islands where lime did not exist, but you had to get it from another island, and it was very expensive and risky and dangerous to go get it there. So limestone makes a good money here. But once limestones become very common, and there's a very famous story that I discuss in the book about an island called Yap, where an Irish sailor is shipwrecked, and then he realizes those people have a lot of resources, and they use limestone as money. And he realizes, oh, well, I can just go get modern industrial equipment, get a large amount of limestone, bring it to this island, and I will buy all the things that they have. And that's indeed what he did. And of course, it created the civil war in the island, basically between low IQ and high IQ. The low IQ said, oh, this is great, he's bringing us a lot of money, we're going to be rich. And the people with the high IQ said, no, we don't need that money. The quantity of money doesn't matter. On the contrary, you want your money not to increase in quantity. If he brings us all this money, we're just going to end up with a lot of limestones, and he's going to take all the food and all the resources that we have. That's exactly what happened. And you see these examples repeated over and over and over again. Glass beads were money in West Africa because Arabs and Europeans had developed the technology for making glass beads. In West Africa, they had not, so they were very rare, so they were used as money. And then Europeans and Arabs were able to come and buy everything because they could get the glass beads very cheaply, whereas the West Africans couldn't make them cheaply, and so they were using them as a store of value. So we see this repeated over and over and over again. When something works as money, it's hard to increase. We see this in government monies as well. The government monies whose supply increases very quickly don't end up having a decent monetary role, whereas the ones whose supply increases slowly end up having a better monetary role. If you summarize all of monetary history as a game, the winner was gold at the end of the 19th century. Why? Because of this theory, I believe, explains why it ended up being gold. There are unique properties to gold that don't exist in other metals. And specifically, that's the fact that the supply of gold increases at a very low rate of only around 1.5% to 2% per year. And gold is unique in that regard amongst all metals because it is a metal that doesn't corrode, doesn't ruin, and can't be consumed. There's no way to consume gold. You can't eat it. In fact, even if you eat it, you don't consume it. It comes out and it's still gold. If you throw a nuclear weapon at gold, it'll boil, but then it'll cool down and it'll go back to being gold. So what this means is that for 5, maybe 10,000 years, people have been mining gold, and that gold has been accumulating. So we have all this enormous stockpile of gold that has been accumulating throughout human history. And even though we get better at producing gold every year, we find more gold every single year, the stockpile is also increasing. So the new production is always a very small fraction of the stockpile. And this is not true for any other metal. It's not true for silver because silver corrodes. And so some of the old silver gets consumed, and now today a lot of silver gets used in industrial uses, and so it's taken out of the liquid stockpiles. So that means that silver is constantly being very inflationary. The supply is increasing at a higher rate than gold, and that's why silver was demonetized and gold became money. So this is my kind of overview of why we could see this monetary history unfolded in this way. And you see this as also happening in the example of government monies, because we went from gold, which was money that had a supply growth rate of around 1.5% to 2%, to fiat money, government money, which has had an annual growth rate roughly of around 14% per year overall over the last 60 years. The best national currencies Think of the US dollar, the euro, the yen, the pound, the Swiss franc. These kind of currencies have annual growth rates of around 7%, 8%, 9%, and that's the best case scenario. Now, the basket case currencies, they can get 50%, 100%, 200% sometimes. Nicaragua is the record holder, 480% on average over the last 60 years, which is pretty impressive. Of course, there's a few years where this drives up the data up. But overall, you average the Venezuelan bolivar and the dollar and the euro and the Lebanese lira and put them all together and account for size so that you're not taking the Venezuelan bolivar as being one data point equal to the US dollar, because the dollar is obviously maybe 1,000 times larger in market capitalization than the Venezuelan bolivar. So you account for that, you add them all together, you get something like 14% per year, but with a clear distinction between the lower end 7, 8% per year to the higher end of 20%. And we see the same issue happening, wherein the harder monies are the ones that continue to accumulate more value and continue to acquire more users, and their value goes up, whereas the easier monies continue to suffer. And so they print more of the money and the value collapses. And the result of this, the result of the fact that we moved from a hard money that had a 1.5% to 2% annual supply growth rate to a form of money that has 10 times the annual supply growth rate is most obviously prevalent in prices. So if you look at prices of things measured in dollars, they are going up all the time. And people think things are getting more expensive. Things aren't getting more expensive. Things are actually getting cheaper. We have more of everything. There are more houses, more cars, more apples, more oranges, more computers, better TVs, better everything than we had 5 years ago. But everything is more expensive than it was 5 years ago. Not because it's actually more expensive. It's because the money has gotten cheaper more than those things have gotten cheaper. Because yes, we're making more houses and more apples and more oranges, but we're making more dollars at an even faster rate. And so that's why the prices of things continue to go up when measured in dollars, whereas if you measure them in gold, they've been flat or declining over the long term, at least. Of course, there's a lot of volatility. And you can see this if you measure the national currencies against gold. Since 1971, practically all national currencies have lost more than 95, 97% of their value compared to gold. And this is pretty obvious as a consequence of the fact that gold increases at around 1.5%, 2% per year, whereas national currencies increase at around 10, 15% or so. So this really helps us understand the problem that we have, which I believe is the biggest problem in the world, and really no hyperbole. I believe the biggest problem in the world is inflation. The biggest problem in the world is that the world is gone back to saving in a form of money that is very primitive and that it doesn't hold its value. It's as if all of our computers in the world were replaced by abacuses. Think of the gold standard as being similar to a computer, and an abacus is sort of like the fiat monetary system. Government money is the only form of money to ever witness a sudden and complete collapse in its value. We've had 60 almost hyperinflations since the move away from gold. And then if you don't have hyperinflation, you usually have high inflation, or at least moderate inflation, which adds up over time. The key thing to understand about government money is that ultimately it's built to finance government spending. It's not built to optimize your user experience. Another way of putting this is that you are not the consumer. You are not the user of government money. You are the product. You are the one who's being used. Having you use that money and store your wealth in it is what allows governments to appropriate that wealth and spend it. So that is, I think, the better way of understanding it. And that helps us understand why Bitcoin. So that helps us frame what the problem is. Now let's look at the solution. Well, what is Bitcoin? And in simple terms, Bitcoin is a peer-to-peer software for operating a payment network that has its own native currency that is protected from unexpected inflation without having to rely on any trusted third parties. In very simple terms, Bitcoin is just software. And this is the most important thing to understand. There's a lot of talk about Bitcoin, and people can use a lot of metaphors which can be confusing. I think it's important to ground ourselves in reality by remembering this is just software at the end of the day. It's just lines of text and numbers. And What it does, what this software does, there's a lot of software in the world all around us, and all kinds of our aspects of our life are increasingly invaded by software. Well, this particular software allows you to run a ledger between a bunch of people that can allow them to have a payment network between one another, so that people can pay each other while using this network and having their balances constantly being updated in every member of the network. That is a form of network that is called the peer-to-peer network. So what distinguishes this is that every single member of the network has the same privileges and the same responsibilities as other members of the network. There is no admin. Everybody is a user. Everyone is an admin of their own node in the network, but nobody is an admin of the network overall. And so the network only proceeds through consensus. You can only be part of the network if you agree with everybody else. Now, why is this important? There are a lot of other forms of software. Why do we think this one is such a big deal? Well, for two reasons, two main properties. Number one, it's the hardest money ever discovered or invented. And two, it's the only working alternative to central banks for international payment settlement. I think those are the really two key points that make Bitcoin such a big deal. The first one, the hardest money ever invented, is when we look at the supply growth rate. So remember with gold, we saw that gold increases at 1.5 or 2% per year. Well, this is the supply growth rate for Bitcoin, which is the gray line here. As you see, initially started off very high because Bitcoin started from zero and production started at zero. So the growth rate, obviously, when you go from zero or from one coin or from 1,000 coins, is obviously going to be very high. But then as the stockpile accumulates, and then the new production is a smaller fraction of the existing stockpile, the supply growth rate declines. And so Bitcoin's supply growth rate today in 2024 is 0.8%. It dropped to 0.8% 2 months ago in April. Every 4 years, the growth rate drops by half because the annual production, the daily production of Bitcoin drops by half once every 4 years. So this is the discontinuity in the gray line. This is why it's not a straight line, because once every 4 years, the growth rate drops by half, and so it declines further. So with this, we see that Bitcoin, starting 2 months ago, became the hardest money that has ever existed because it's now operating with a growth rate of only 0.8%, and that's going to go down to 0.4% in 4 years and then 0.2% in another 4 years. And the supply is done so that it increases at a rate that is constantly decreasing. Eventually, the supply growth rate drops to zero, and the stockpile flat lines at around 21 million Bitcoin, exactly. So there will never be more than 21 million Bitcoin. There will never be the production of more than 21 million Bitcoin. So this means that, remember the analysis that I started with, we're always moving toward the harder money. In any society, at any time and place, people are always moving toward storing their wealth in the harder money. And so here's the harder money now. And I think the implications are pretty obvious. People are going to start moving their wealth to it. And I think a key point from the Bitcoin standard is that this isn't Apple versus Android or Pepsi versus Coca-Cola, where, you know, if Pepsi manages to run a better ad, it might overtake Coca-Cola, or Burger King versus McDonald's. There's something very brutal and Darwinian about the way monies compete with one another, which is that it's not an option, it's not a popularity contest. If everybody in the world tomorrow decides, all right, or let's say 99.999% of people on the world decide, you know what, money is bad, let's make tree leaves as money, because then everybody will have money. We're not going to be able to make tree leaves as money. All that happens is that everybody who goes along with using tree leaves as money is going to end up being poor and destitute. Money is only going to remain with the people who don't go with that silly idea. So it's tempting for people who, you know, we live in a democratic age and people think they get to decide everything. Well, this is one thing that you don't get to decide because it's economic reality. If you choose the easier money, the wealth you store in it is going to be dissipated. If you choose the harder money, you keep the wealth, and therefore the wealth concentrates in the hands of people who choose the harder money. And that's why this is, I think, just an inevitable process. But beyond that, Bitcoin is truly unique because its supply is fixed, which is really remarkable. And the fact that its supply is fixed is really how Bitcoin is very different from every other form of money. Because with every other form of money, even gold, if more people use it as gold, there will be more incentive to produce more and more of it. The more people use something as money, more of it will be produced. Bitcoin is the only form of money whose production is completely independent of the demand for it, which is a truly, truly incredible thing. Because if tomorrow 7 billion people want to use Bitcoin, we're only going to produce 450 Bitcoin. That's the current rate. Every day there are 450 Bitcoins being produced currently. So if 5 billion people want to use Bitcoin tomorrow, there's only going to be 450 Bitcoin for them to fight over. If 5 people, not 5 billion, also want to use Bitcoin, the code doesn't care. It's only going to make 450 Bitcoin. And that's truly remarkable. How does the code just stick to making 450 Bitcoin, and it is completely indifferent to whether there are 7 billion or 7 people that are using it? And the answer is because of the magical thing called the difficulty adjustment. And that essentially means that as the number of people who are mining Bitcoin try and increase the amount that they mine, they don't get more coins. Mining becomes more difficult, and the output of the coins continues to stay the same. I think this was the most revolutionary and important new thing that Bitcoin added. If you look at all the other constituent pieces of Bitcoin, technologically they'd all existed before. Proof of work, digital cash, all of these ideas, cryptography, hashing, all of those things, they'd existed for many years and sometimes decades before Bitcoin came about. But what Bitcoin did was that it combined them all and added difficulty adjustment, which is the magic glue that holds the entire puzzle together. Because what it does is that it allows the network to continue to grow without sacrificing the fixed supply. That's the way that works, is that the mining difficulty adjusts rather than the mining output. So we're only going to give out 450 Bitcoins today. And if a lot of people are mining Bitcoin becomes a lot harder, so that you're only going to get the 450 coins. If only a few people are mining, then mining Bitcoin becomes a lot easier. Both cases, we end up with only 450 coins. So this is what distinguishes Bitcoin from every other money. Every money, this demand for money as a store of value causes the price to rise, which causes mining to become more profitable, which causes the supply to increase, which causes the price to drop. With Bitcoin, if there's a demand for it as a store of value, the price will rise, mining will become more profitable, and that doesn't cause the supply to increase. It causes more hashing power to go into mining. So mining becomes more complicated, so people are spending more resources on mining, which makes the network harder to attack, which makes Bitcoin survive longer, which makes it more reliable as a store of value, and that drives more demand for it. So whereas there you have a negative feedback loop that moderates this, that stops the asset from appreciating because we're dumping more of the quantity onto the market, here you have a negative feedback loop, a positive feedback loop, where the more people try to mine, the more the price goes up, the more the value of the coins goes up, the harder it is to attack the network because the mining becomes more difficult. So more resources go into mining, and so the output is that the network becomes more and more secure, which drives even more and more demand. And that's how we can understand how something can go from zero to $1.4 trillion in 15 years. Nobody has ever done anything like this. Nothing has ever appreciated this much. From zero to $1.5 trillion in 15 years is unprecedented, and I would imagine, in real terms, unlikely to be matched by anything ever again. And that's because of the difficulty adjustment. So it protects the network from inflation, it ensures the supply is auditable and verifiable by all network members, and I get into this in more detail in the Bitcoin standard, which you can read in more detail. And the end result is that Bitcoin does about 500,000 transactions a day, but it uses roughly 10 million times as much processing power as the world's top supercomputer, or 1 million times the world's top 500 supercomputers combined, around 10 trillion times as much as your laptop. So the amount of hashing power going to producing Bitcoin is like 10 trillion laptops of yours. This is the army that we have churning out Bitcoin. So you can do the same transactions on a single computer. 500,000 transactions can be done on a basic computer that you buy from any electronics shop. But Bitcoin does this without having to rely on any authority. The problem with doing 500,000 transactions on your laptop is you could ruin your laptop. You could turn out to not be trustworthy. Someone could put a gun to your head and change the record of transactions. And so that's unreliable. But if we have millions of computers around the world doing this work, then we're not reliant on any of them. We're able to run this network entirely without having to rely on any one particular individual or entity. And that is another thing that is truly mind-blowing about Bitcoin. It has no single point of failure. There isn't any piece of critical hardware or infrastructure anywhere in the world that can cause Bitcoin to fail. There's no building that you can bomb that will make Bitcoin stop working. There are no servers that you can turn off that will make Bitcoin stop working. There's no individual you can kill that will make Bitcoin stop working. It's effectively cannot be stopped. It's a protocol that's always open to anyone who wants it. And around every 10 minutes, a new block of transactions is released, and it's never failed. It's never confirmed a fraudulent transaction. And it does that without having anybody in charge, which is truly the mind-blowing thing, because it means you don't have to trust anyone. You don't have to rely on your government being made up of honest people. You don't have to rely on your central bank not creating inflation. You just rely on code in the same way that you rely on all kinds of other machines and programs in your life. So the unique thing about Bitcoin is that it is the hardest money ever invented, and it's available worldwide for anyone who can receive 2 megabytes of data every 10 minutes. It's purely voluntary. It does not need regulation, enforcement, or police. And it's chosen and valued freely on the market, which is what we refer to in economics as sound money. Money whose value and choice is dictated by the market. People freely choose it, not at gunpoint. So with this in mind, now we move to thinking about the investment case for Bitcoin. The investment case for Bitcoin, if I were to think of it, is this. As we think of it as a monetary asset, and we compare it to other monetary assets. What are the other monetary assets out there? Well, there's gold, and gold's stockpile increases at around 1.5% to 2%, as we said. There's fiat money, which does about 14% per year. There's the best fiat currencies, the dollar, the euro, Swiss franc, etc., and they increase at around 8% per year. The worst fiat money is at 50% to 100%, and Bitcoin, 0.8%. So it wins purely on the supply growth rate. And you might think, well, this is not a big deal, 0.8% versus 2% or 0.8 versus 8%, it's just 7 percentage points. No, run the numbers, start off with two quantities of say 100 and then look at what happens if you add 0.8%. Well, it's not even 0.8% for 20 years, it's 0.8% for 4 years and then 0.4% for the next 4 years. So basically there will only ever be another 1.5 million Bitcoin produced over the next entire century. So there will only be an 8% increase in Bitcoin for the rest of history, or about a 9% increase in the supply of Bitcoin is what's going to happen over all of the next century. And then that's it. And then we're just breaking the mold, and we're not going to be making any more Bitcoin. Now compare that to the dollar growing at, say, let's be optimistic here and say 5% a year. Now, add up 5% a year after 5% a year. I mean, they add up. In about 15 years, the quantity will double at 5%. So Bitcoin will have increased at a 5% in 15 years. Fiat money will have increased at 100% in about 15 years. Extrapolate further, and you can see where this is going. Something is going to become incredibly more abundant, and therefore it's going to become incredibly cheaper. That's the basic big picture idea. But I think the way to think about investment case for Bitcoin is to differentiate between the demand for investment and the demand for saving. And this is a very important concept. Most people today don't really have an understanding of this distinction because saving is practically not possible anymore, because you can't save anymore in national currencies because these currencies are constantly losing value. So every person who has ever worked in the money management industry knows that cash is trash. Cash is not a good asset to have in your balance sheet. You need it, of course, but you want to try and move away from it. And so historically, under the gold standard, things were different. People had savings in gold because they could expect those savings to hold on to their value, which is the case because gold supply only increases at 1.5% to 2%. So what that meant was that you could save, which means that let's say you're a doctor, you're an engineer, you have an actual job, you're out there. You don't have to be a hedge fund manager in your spare time in order to know what to do with the money that you've already earned. If you've earned the money drilling people's teeth or building houses for people or doing any kind of job for people, you've already earned it, you've already worked for it. If you can just have access to a form of money that is not terrible, then you can keep that you can keep that wealth with you and you can benefit from it. But if you don't, then you can't keep that wealth there, and then you must invest, which in most cases, for most people, really is gambling, because the vast majority of people don't really have the expertise or the knowledge to be able to really invest in a proper manner. Look at a balance sheet, figure out the assets and the liabilities and the expected future earnings, and then figure out a fundamental price for the share, and then make that decision. No, and in fact, even professional investors don't really do that anymore, because it's becoming much more about momentum. So it's a very, very tricky thing, and it's a very difficult thing to do. But it's something that you shouldn't be doing if you just had a form of money that doesn't suck. If your money wasn't terrible, you don't need to be a part-time hedge fund manager. You can just focus on your job, drilling teeth or building houses, and that's it. And then if your money is not built to rob you, you don't need to become a part-time hedge fund manager. So the investment case for Bitcoin is essentially that holding a verifiable fraction of a fixed supply money outperforms the vast majority of investments in a devaluing monetary system. I think this is the way to think about it. If you're using a form of money that's constantly devaluing, it's like you're running uphill. You need to be, you need to hit 7% return just to stay constant. So if your money is losing 7% a year, you need to be making a 7% return just so that you avoid losing the wealth that you use. And here most people think that the barrier that they need to clear is the CPI number. But I believe there's a very good reason, which I discussed in my second book, The Fiat Standard, why that number is, it's a government statistic. So governments are very good at one thing only, which is making things up. So this one is designed with the intent of making it look like it's a low number. But in reality, I think a much better measure for inflation, I tell people, is look at your dream house, the house that you would dream to live in. Think of the city, the neighborhood that you would want to live in, and then think of the kind of house that you dream about living in. And look at what has happened to that price of that house over the last 10 years. That's your inflation rate. Because your house is going to be the major expense. For most of us, the major expense that we're ever going to incur is the house. And that's the bar that you need to clear. What will I do? If the price of the house is going up higher, faster than your portfolio after taxes and fees, you are losing out, and it doesn't matter what the CPI is saying. It doesn't matter if electronics are getting cheaper. Of course, electronics are getting cheaper. Productivity is increasing the prices. Yes, you're going to be able to afford a better laptop 5 years from now than the one that you have today, but you're not going to be living in the house that you want. You're not going to be able to afford the healthcare that you want, the university that you want, these kind of valuable things. So Bitcoin, on the other hand, you don't even need to invest. You're just buying a share of a fraction of the entire supply. And because the supply is not being expanded, then that wealth is not being dissipated out of it. So you just basically save in Bitcoin and live your life rather than in trying to be a hedge fund manager. This is what I believe is the kind of general case for Bitcoin theoretically or conceptually. But I think today, because Bitcoin is so early in and it's attracted such a tiny fraction of the overall market that it could address, we can think of it in a different way. And that's that you think of Bitcoin as being a competitor for all of the world's cash balances. We have roughly around $100 trillion in physical cash and checking accounts, around 120, I think, trillion dollars in government bonds or so, around $10 trillion in gold. So and also some of the market for stocks, real estate, and art is also cash. People are using, art or real estate or stocks as a medium of saving rather than just as a form of investment. They're using it as a form of money because their money is broken. So the total addressable market we're talking about is something in the range of $200 to $300 trillion, not billion, trillion. So $300,000 billion or $300 million, which is a lot of dollars. It's the biggest market of anything. And most people don't think of money as a market in itself because we just think money is just, money, government gives us those pieces of paper because they like us. And thankfully, we are able to use them and then we can buy things. But money is a market and it has demand and it has supply. And people hold money for a very good reason. It's important to hold money because money is the most liquid asset. It's the asset that allows you to spend most easily. So there's always going to be demand for money. And we're talking about 200 to 300 trillion dollars of demand. It basically puts everything else is a rounding error next to it. We don't think of money as a market, but it really is the biggest market. I can't think of any other market that comes anywhere close to that. I mean, you could think of things like, as I say, the healthcare is 10 trillion, 20 trillion or something like that, but that's not some kind of centralized good. There isn't some factory in the world that's minting out healthcare and selling it and being able to collect that. But Bitcoin on its own, just the form of software, is essentially up for $200 to $300 trillion of assets. And it is a superior cash asset to all the other cash assets out there. But only 0.5% of global cash balances are in Bitcoin today. But more and more people are beginning to recognize this. But if demand goes up, if the demand for Bitcoin doubles, which is entirely feasible because the current demand for Bitcoin is around $1.5 trillion, it's entirely feasible that we could go up into $3 trillion. But if that doubles, how do we make more Bitcoin for all those people? We can't. The whole point, nobody can make more Bitcoin. So how are they going to get all their Bitcoins? The price of the current existing Bitcoin has to go up. And that's the amazing thing about money. Because remember, we said money is not a good that you acquire for its own sake. The quantity of money doesn't matter. That's why if I gave you a choice between $1 and 10 Japanese yens, you'd take the $1. You don't prefer the Japanese yen because 10 is bigger than 1. You care about the purchasing power. So it doesn't matter what quantity of money you have. It doesn't matter how many dollars you have. It doesn't matter how many Bitcoins you have. What matters is the purchasing power. And if you pack more purchasing power into a dollar or a Bitcoin or a gold, you are able to meet more demand for those things without having to increase the supply. That's only money that has this. So that's why it's so different from every other good. So if demand for Bitcoin goes up, the price of Bitcoin is going to appreciate significantly. And run the numbers, $200 trillion divided by 21 million Bitcoin. Leave that as its homework for you to do it and think about it on your own. So when you look at it that way, if you're going to eat up all of that market for cash balances, we get a different investment case today from the overall conceptual investment case that I mentioned of Bitcoin as money. In other words, the Bitcoin conceptual case I mentioned is you use it as your cash balance. And yeah, everybody needs to have a cash balance, but you don't have all of your money in cash, right? You want to take risks, you want to invest, you want to hold other kinds of assets. But currently, because Bitcoin is such a tiny fraction of its total addressable market, I think it's buying in it today is more like early stage VC investment than cash holding. Because what you're doing is effectively, let's say, think about Uber. You're investing in Uber. What are you doing there? You're making a bet that this form of software is going to put a lot of taxi cabs and a lot of taxi cab licensing bodies out of business or compete with them or change their business model. And therefore, that's going to be extremely valuable. So if you had the chance to invest in Uber, say, 12 years ago, this would have been an asymmetric bet because the upside is enormous. And if Uber works in a few cities, then it can work in many, many cities. And then the upside is enormous. Bitcoin is a little bit like that. It's currently only 0.5% of its total addressable market. So if you're investing in it, you're not just investing in the idea that, okay, this is a good cash balance that I'm going to have. That would be the case. That would be the investment case for Bitcoin in a world in which Bitcoin is already 80%, 90% of global cash balances. In that kind of world, you are taking Bitcoin as a cash balance. You wouldn't be expecting to get a lot of appreciation because if it's 90% of the world's cash balances, then there's only another 10% for it to go to appreciate. So that 10% might take another 10 years. So you're only getting a little bit of growth from the growth in the addressable market. Whereas right now, it's very different. Right now, you're betting on this thing disrupting the cash balance industry. And so now, when you think about how it's performing, it's not performing as a form of cash that holds on to its value. Because it's being monetized and going from zero to who knows how many $1 trillion eventually, it's outperforming all the other forms of investment that you can look at. And this is I just recently ran the numbers on this. If you look at what would have done if you had invested $100 after 5 years or after 10 years in these assets, you can see Bitcoin is in a completely different league of all the others. So long-term treasuries are just a way for you to lose money because your money is losing value, and then the treasuries are losing value in money that is losing value. So if you bought treasuries, congratulations on a double loss. Really, nobody should ever buy treasuries. It's a horrible thing. But it's really the best punishment for buying treasuries is buying treasuries. So that's obviously not a good thing unless you really love poverty and you hate your children and you want your children's future to be given to governments. Real estate is obviously a lot better. It appreciates, but real estate involves taxes, it involves costs, and it involves maintenance. So you barely beat inflation with real estate. Gold has also not really done much. 180 over 10 years, so 80% return over 10 years in the last 10 years has included a lot of inflation. So if you, again, think about the price of your house, your dream house, how much has it gone up over the last 10 years? I would bet for most of us it's gone up more than 80% over the last 10 years. So if you've held on to gold or if you've saved in gold, you are probably moving on to a less valuable house. The S&P 500 and the NASDAQ are the two things that you could say beat inflation. Yet still, if you look at the annual growth rates, about 14 to 12%, 15%, something like that. When you factor in taxes and fees, capital gains taxes and fees, you are more or less not, I mean, you may be coming out a tiny little bit ahead, but then don't forget you're taking on equity risk here. And there are always risks with equity investment. And then we get to Bitcoin. 54% compound annual growth rate over the last 5 years and 63% over the last 10 years. 60% annual growth rate, compound. So 60%, then another 60%, then another 60%, then another 60%. That's a lot of percents. I mean, they add up. As you see, over 10 years, $100 becomes approximately $14,000. So that's an enormous, enormous increase over 10 years. So it's a completely different asset from all the other assets because, as I said, simply holding on to an asset that is not being devalued puts you miles ahead of people who are playing the rigged game, people who are running uphill. So you're running a race where you have a flat land up against somebody who's running the same distance but uphill. It's really like cheating. But the difference is you're trying to tell everybody that you're cheating, and they just don't believe you, and they don't want to believe you. And you can see this if you look at it in terms of charts. Again, over the last 10 years, that thing is not the x-axis, though it looks like it. It's gold, S&P 500, and long-term U.S. Treasury bonds. As you can see, over 10 years, it's practically zero compared to Bitcoin in terms of its performance. And over 5 years, you can at least see them. But again, the gap is enormous. So I think this is really going to remain the case for a while because I don't see anything different changing in Bitcoin. If my analysis is correct in explaining how Bitcoin has evolved over the last 15 years, because of this process, because of the fact that its supply can't react to increased demand, well then, this is quite significant because nobody, as far as I can tell, has figured out a way to make Bitcoin's supply increase. And spoiler alert, they're not going to figure out a way. And you can read why more in detailed discussion in my book. But basically, there's not going to be more than 21 million Bitcoins. There's going to be a lot more dollars. So currently, the investment case, and I think why it's at once the asset for the mom and the dentist and the grandma that doesn't want to think about investing and just wants to hold something that's secure, that doesn't have counterparty risk. But at the same time, I think it's the asset for the very sophisticated hedge fund manager because what the hedge fund manager is looking for at the end of the day is returns. And I think this is going to be the best place for getting returns because you're looking at a world in which this could eat up practically all of the world's cash balances. So in the same way that you were investing in Uber early on because it was going to disrupt the taxi industry, here you're investing in Bitcoin because it's going to disrupt the cash balance industry, which is huge because it includes cash balances and in the form of physical cash, bank accounts in the form of checking and saving accounts, and perhaps most importantly and most significantly, bonds, which is what institutional investors and large corporations all use as their cash balance, and also a lot of people who use them in the saving accounts. So those three things produced by governments and central banks are basically Bitcoin's addressable market. And I think an investment in Bitcoin right now is a bet that Bitcoin's percentage of the global cash balances is going to increase from 0.5%. And if you ask me, I think that is probably a good bet. Obviously, I'm incredibly biased, but I'm biased because I think this is the case. Because you could look at the competition; they're all increasing their supply and losing value. So it's only natural that Bitcoin would appreciate. Bitcoin doesn't even need to get more and more demand in order to continue to appreciate, because the supply is constantly declining. The bar is so low for Bitcoin that if daily demand drops, daily demand needs to drop by more than 50% over 40 years in order for the price to rise, because the price is determined at the margin, daily demand, daily supply. Daily supply is dropping by half every 4 years. So as long as demand drops by less than half every 4 years or goes up, then you would expect that at the margin the price is likely to go up. So this is how I would frame it as the investment case for Bitcoin, how I would see it. But I should clarify that this is a highly volatile asset, and that it is not something that you would want to invest in the short term. It's something to think about in the long term. So you wouldn't expect these sort of things to show up in a month or 2 or 3, because it's highly volatile, because, again, we're talking about an enormous amount of demand versus a very small existing market. So the demand fluctuating can cause the price to fluctuate significantly, which is why you shouldn't make short-term bets on this. But I think in the long term, I believe the case is unassailable. And that is it for me. Thank you very much.